Why did the cartel actually, I mean, it was a quick and easy agreement from OPEC Plus. Is this because they found some consensus, or is it simply because demand looks good in the next couple of months and they're not too worried about the world economy?
Well, I think they're looking at trying to get inventories back down to pre-COVID levels, and the rate at which they're bringing supply online with relatively consistent estimates of demand, suggests they're on target for the end of this year of being completely normalized. And now, in terms of, which is why they talk about the April 22 as being the point which they can exit the agreement. But I think to put this in context in terms of the pricing of the market is that the 400,000 barrels per day per month, you put that in the context of the disruptions around Ida, that means you would basically erase this, within 8 days. And I think that's really what we need to be thinking about is what's going on in the U.S. right now, because you're not getting any incremental supply from that region.
I mean, crude, Jeff, has rallied about 40% this year. What's the optimum level? Does it stay amongst the $70 to $75 mark?
I think we're going to learn what that new equilibrium is. We have not seen a big uptick in investment drilling in the U.S. Our target is we're going to $80 a barrel in fourth quarter. As we spike above 80, we're going to find out if we start to get that big uptick in drilling activity that many people would have thought would be happening, today in the $70 a barrel range. Remember, we almost were at 80, going back 6 weeks ago. So I think, the jury is out on where that new equilibrium is, because let's think about all the factors that are driving up, the underlying cost structure. It's everything from, labor costs, transportation costs, cost of capital, particularly the cost of capital, given the restrictions around ESG investing.
Yeah, we have a viewer writing in with a question, Jeff, that I think it connects to that as well, asking about overall energy markets at high prices not seen for some time. A, do you see that continuing? And B, does this fall then into inflation readings going forward?
Well, our view, this is just the first ending of a multi-year, potential decade super cycle in commodity prices, driven by three fundamental themes. One is, this policy of redistribution. We're seeing it all over the world, in particular, in China. They just, they call, they just, it was last week, I think, what is it? Common, I can't remember the name of the term that they use for it, but we see it in the U.S. with that $3.5 trillion potential extension of the budget. The other big theme is what's going on in the environment. This war on climate change is having a huge impact on gas prices, particularly in Europe. You have gas prices in Europe trading in, double digits per MMBTU, driving up coal prices. Gas prices are trading at parity with diesel. We haven't seen that since 2006. Gas prices in the U.S. just topped $4.50 per MMBTU for, again, the first time since 2014. So this is not just an oil story. We're seeing it across the board, particularly given the environmental. And then the other big issue is this whole idea of resiliency in supply chains around, what do you want to call it, the Cold War with China. We have, onshoring going on in the U.S., transportation bottlenecks. So, again, we think this is just the beginning of, a potential, multi-decade type of environment, or multi-year potential decade type of an environment.
We have a great story on food supply chains on the Bloomberg. Fabiana Batista, Megan Durson, and Sibylla Gross write that in Vietnam, the army has to assist with the rice harvest. In the UK, they need to dump out milk because the truckers aren't coming to collect it. In Brazil, it takes 120 days to reap the coffee harvest rather than the usual 90 because they just don't have enough people. Is the food inflation and even the shortage of labor in that market going to be a problem?
Well, at least over the next couple of years. Food is different than oil or metals. Oil or metals, you have to make long-term, large-scale investments to solve the problem. In food, you make an investment in acreage and investment in yields, you'll end up being able to solve it with a good cooperation of weather rather quickly. But even there, we look at the acreage, it's also being restricted in the most recent acreage report in the U.S. Because again, poor returns across the sector for quite some time. So it's not just these labor, or let's call it variable cost issues that you're referring to. There's also more structural factors at play. We call it the revenge of the old economy. Poor returns in the old economy going on anywhere from 5 to 10 years now has restricted the ability to grow supply at the context that you have the stars. Big uptick in demand is creating these tight markets. Again, underscoring why this is just the first innings of a multi-year story.
Let's talk more about the industrial metals, because China's metals industry group yesterday said aluminum has gotten entirely disconnected with the fundamentals, with the rally that we have seen. Do you think it can persist?
Absolutely. The thing with aluminum is there's a paradox in the sense that it is going to be critical. It's a critical green metal to solve climate change issues. So it's got to have that demand, but it's one of the most polluting metals to create because you have alumina, which has got the red mud associated with it. China has huge emissions because remember, it takes a lot of power to produce aluminum. And as a result, you get a lot of carbon emissions out of it. So you need it to solve climate change, but it creates the climate change problem, which means you're going to be in a rock and a hard place to produce this stuff. And then you have to ask the question, who's going to produce it?
So yeah, that's a classic example of a catch-22, I think, Jeff. And then talking about the precious, where are we going to find a catalyst for gold?
All right, when we look at gold, there's three legs to the story. One is, Western investment demand, and I think that's the one you're referring to, that's the weak link. But the other two are quite strong. Central bank demand is quite strong across the board right now. What's different about central bank demand? It's not just the Turkeys and the Russia that's out buying gold due to political concerns. You have like the Polands of the world buying it for diversification. So it's large scale investment from central banks. Plus, we look at the arbitrage into China. Very strong physical demand going into China. So the only weak link is the Western monetary demand. And I think there you need to have a focus on what inflation risk. And I think a rally in oil prices above $80 a barrel could be that catalyst that gets people back into this market. Our target on gold is $2,000 an ounce.
Jeff, the underlying question for everything that you've just talked about is, of course, what do we do with China? Is the third quarter data something of ugly, a symptomatic of something that's quite sinister? Where do you put China right now? Near term, China's going to underwrite any potential weakness right now, particularly off the back of the weakness that was created this summer with the Delta variant. But I want to be careful about the weakness. The weakness that we're seeing is very idiosyncratic and intended at a very industry level. So let's take like steel. Steel demand in the first half of this year was running like plus 8%. Most recently, it's dropped to minus 5%. People go, oh, I'm very concerned. But steel is one of those sectors that they're targeting for environmental reasons to shut it down because it's very, creates a lot of emissions. But also the weather was not cooperative to construction over this summer, and that also created that decline. So now that you have, there's a lot of potential for special purpose bonds at the local level that can be used for infrastructure spending that can create that uptick as we go towards the end of this year. I remember the term that China uses, common prosperity. And that common prosperity means that they're going to be focused on these redistribution themes that you're seeing in places like the United States and in Europe. In Europe, here in the UK, they call it leveling. That's going to create a lot of demand for commodities as we look out into the forward. So China, I'm not worried about. But here's one last point I want to say about China is the world's not China-centric anymore. The world is global in the sense that U.S. and Europe are very much part of this story, and you can even see how copper prices are tracking U.S. and European PMIs now, no longer Chinese.
Jeff, you have common prosperity in China. You've got leveling, or the typical sort of democratic socialism that we have here in Europe. In the U.S., in regards to tax policy, and we talked to this about David Costin, what do you expect and how does that change the picture?
Well, when we look at the tax policy, it's not, obviously it's going to have a big impact in David's space because it's going to impact it directly. But when we look at the space for commodities, and here's a really important point about commodities. Physical markets are driven by volume, not finance. In fact, I really want to take a second to explain this because it's critical. Let's take David's markets. They're financial markets. They're driven by how many dollars come into those markets. Let's take commodity markets, physical markets like oil. How do we calculate for bullish oil? The barrels of oil consumed has nothing to do with money or money flows or anything like that, just volume. And so when we think about high income groups, what do they control? Wealth and income. They can create financial inflation. They can drive David's markets. Can they drive the commodity markets and physical markets? It's numerically impossible. There's not enough of them. The only group that can drive commodity markets in the physical markets are going to be the low income groups. And so when we think, because they have the volume, and so you can think financial markets driven by higher income groups, physical markets are driven by the lower income groups. And so when we think about these tax policies and you think about redistribution going on around the world, it's going to create that volumetric demand growth that drives commodities and physical markets.
Jeff, let's just quickly talk about a market that is decidedly not physical, just digital. Bitcoin dancing around $50,000 once again today. What is the Jeff Curie take on crypto?
Well, when we think about crypto, is that it's a network. The value of the network is what drives the value of these coins. The coin unlocks the network. They're decentralized. The decentralized internet. I like to think about what is Apple iOS. Apple sits at the top, and you have the iOS down there, and you have all the different application producers that report into Apple. All these different cryptos do is they take out the Apple. It's decentralized, and it allows, and the coin is used to create the wealth to trade within that ecosystem. Do I like them as a commodity? Yeah. It's just like oil or one of the other. In fact, we like to call it much more closely akin to copper. Digital copper, because it is pro-cyclical and it trades that way. So I wouldn't think about it as being digital gold. It's not digital gold. One last point: gold can exist outside of the network. Oil, copper, and Bitcoin or Ethereum, they need their network. Think about oil has no use without a car. Bitcoin has no use without the blockchain. Gold is different than all those. Gold you can bury in your backyard.